We've asked Luke Gromen, the founder and president of FFTT LLC, to join us this morning to have a look at the week in currencies. Luke, it's great to have you with us. Thanks for giving us part of your Friday. I want to begin with the ECB, the rate cut, QE, and comments from Mario Draghi. I guess my first question is, are there actions that they've taken, the central bank actions that they took yesterday, is it going to be enough to move the growth needle?
Yeah, hi Ben, thanks again for having me on. You know, I thought the reaction to the ECB yesterday was really interesting in that, of course, we had the euro sell off sharply initially, and that led to the dollar rallying sharply initially. And then, after a few minutes, that faded and completely undid. And actually, the euro finished the day higher, dollar finished the day notably lower. And, I think it was interesting to see because you started to see a sell-off at the long end on German bunds, and I'd been kind of wondering, hey, is there a carry trade here where the bunds actually start to sell off? Would that force an unwind of a carry trade that would ultimately lead to selling dollars? And I don't know if that's what we began to see yesterday, but it seems possible. But in terms of, will this drive growth? I think that's the key question. And I think during Draghi's press conference yesterday, he said something really interesting in my view, which was he talked about monetary policy within the context of fiscal policy, and effectively saying basically that had fiscal policy been more aggressive, our monetary policy would have been more effective. And there were a number of people understandably sort of razzing Draghi in the media for that comment. But I think that's the key question. There was a paper written, it was a BlackRock Institute white paper written by former Fed Vice Chairman Stan Fischer, former Swiss National Bank Chairman Philip Hildebrand, and former Bank of Canada Chair, Jean Boivin. And the gist of the paper was, in the next slowdown, we're going to need to go direct. In other words, we're going to need to basically do helicopter money, and we're going to need to cap yields, and we're going to need fiscal stimulus sort of as part of that. And so to me, Draghi's comments about fiscal coming up again within the context of monetary policy tells me this is being discussed intensely by a lot of different central bank governors around the world. And the point being is that I think they're going to move in that direction. As they do, I think eventually market participants are going to understand that and begin to reflect that. And I think that will ultimately drive growth. Now, that has some other implications as well. But I think we're starting to move in that direction again, bottom line.
Yeah, I guess my concern, having said that, is if it doesn't, at what point, where are they going to be? If this isn't the stimulus that's needed, what is? You mentioned something a little bit more direct. I mean, what would that be?
Yeah, this BlackRock white paper from August was jaw-dropping to me, and that takes quite a bit of doing these days, given how crazy markets are. But what I think it will be is some version of central bank helicopter money, where the paper talked about bypassing the traditional interest rate channel, going direct in terms of stimulus, and then if bond markets back up because of that, which you think they would, of course, in terms of particularly long ends of curves. They talk openly about capping interest rates with the, basically with QE or whatever it would take. They have the ability to do that. They can control their balance sheet, or they can control, they can control the price of money, but they can't control both. And so, the quantity of money or the price of money, but not both. And so, I think from here they are thinking and talking about getting much more aggressive. And I think right now the markets don't believe them. Maybe with what's happening in bonds over the last week, maybe they're starting to a little bit, or at least fearing they're starting to believe them. But I don't think a quorum of investors believes that they could do this yet. But I think that's where we're going.
Noted. Let's talk a little bit about the yen. It's been on the move. I'm wondering, it's been coming off. Is there anything other than that risk-on sentiment behind this move, or is this really just what you'd expect to see, Luke, in terms of the indices rallying back? You mentioned treasuries, bonds coming off extreme levels, and I mean, ultimately, yen's going to suffer, and they're going to pull back some.
I think it's mostly just sort of a reversion of that risk-off trade. There were some comments Kuroda made, I think it was last week, talking about that he would like to see the yield curve a little steeper than it is, and that led to some concerns about maybe the Bank of Japan policy going forward might be a little bit less aggressive at the long end of the curve. But I think it's mainly about just a reversion, at least in the near term, of that risk-off trade.
One thing I've been watching is the dollar. We saw it spike up yesterday to the 99 handle. The euro actually made a new low, Luke, yesterday for the year, but the dollar didn't in terms of the futures at least. And I'm wondering really, what is all this central bank dovishness? We've got the Fed next week. What does it mean for the U.S. dollar? It's managed to hold upper levels for the most part, but I'm wondering, are we starting to come off? Are we no longer the king of the hill? Has something started to shift? That was a major move lower yesterday off those recent highs.
Yeah, I think, to me, I think what the Fed does, going forward is key. But I think also within this, we have the domestic political situation. Mm-hmm. And by that, I mean, you had Trump tweeting, I guess it was Wednesday, about the boneheads at the Fed, which is incredible in itself. But underlying that tweet, I think there is a growing awareness of the fiscal side being challenged for the U.S. And I think, the more we have the S&P 500 at near all-time highs, and the Fed's going to cut rates. And I think they're going to need to keep cutting rates, as we've been talking about for a while. We don't think it has anything to do with the economy or the stock market. We think it has everything to do with effectively financing U.S. deficits. And so, to the extent that we now have, the ECB out of the way, all eyes shift to the Fed and start really digging into that. And so, I think that, to me, is all else equal on the margin dollar bearish. Now, the one thing that gives me a little bit of pause, at least tactically, is I was looking at Eurodollar futures the other day, and they are, this trade in the Eurodollar futures market in terms of incremental stimulus from the Fed is on in a big, big way. And so there is some level of expectations that seems built into that. But ultimately, I think we're still in the early innings of the realization that the Fed is going to effectively need to continue injecting liquidity to help finance U.S. deficits effectively.
Yeah, that'll be interesting to watch the U.S. dollar if that continues. I mean, considering that rates in the U.S. dollar have had such a disconnect as of recent. Luke, one more question, then we'll let you get going. Retail sales today headed our way in just about 6.5 minutes. How big of an impact could this have on the Fed's decision, on markets today, and what are you going to be looking for?
Yeah, I'm interested to see the numbers simply because we did get that, market risk off in August, particularly in the first half of August. And so it'll be interesting to see if that filtered through, because there's been a pretty tight correlation on a bit of a lag with risk asset prices and the stock market in particular and retail sales. We saw that early in 2019 and then again in 2Q19 after the market had rebounded. You saw a pretty sharp rebound in retail sales, beating expectations. And so I'll be watching that, and I think it'll be interesting to see if that translates through. And then I'll just be watching whatever the print is. If it is a good print, then I think that's further going to put the Fed in a bit of a bind, but ultimately reveal that they've still got to cut rates anyway, because it's not about what retail sales or the economy's doing. It's about what U.S. deficits are doing to U.S. money markets.
Noted. Luke, really appreciate you joining us here and closing out what's been a big week with us here on the Future Show Traders.